Then once you make a new all-time high and break out in anything, you generally add about 10% to price just from, good feelings, some good publicity. People think they're missing out, and so a whole bunch of new money rushes in. And that's why I always thought gold might go to 2,300. Well, and here we are, 25 something, and have maintained and have broken out since, even a little further of, then we go into this 3.5 month range. Now we've broken out of that. So it is really almost kind of counterintuitive what happened, what has taken place. And I'm not arguing with 25, $50 gold, 25.50. That feels pretty good.
In a recent analysis, Craig Hemke, the respected financial analyst and founder of TF Metals Report, illuminates the current dynamics in the precious metals market. Craig Hemke highlighted the outstanding performance of gold, noting a substantial increase in price from $2,100 to $2,450 in just 6 weeks. He specifically linked this surge to the market's expectation of more supportive Federal Reserve policies. This anticipation was fueled by comments from Fed Governor Christopher Waller regarding the possibility of future quantitative easing. Currently, gold is holding steady at $2,520 per ounce, reflecting a 0.31% increase from yesterday and a 0.92% rise from the previous week. As markets digest the latest U.S. consumer inflation data, gold remains resilient, with the 52-week high of $2,526 within reach and traders anticipating a smaller rate cut from the Federal Reserve. Despite gold's strong performance, it's important to note that many investors seeking additional gains often turn to gold mining companies. However, these companies frequently fail to reflect the same price increases as the metal, causing investors frustration. While physical gold remains a reliable investment, having achieved significant milestones this year, it's worth considering that gold stocks also offer potential opportunities. Despite lagging behind the rise in gold prices, these stocks are worth considering for investors who want to diversify and capitalize on future gains in the gold market. Despite rising gold prices, the weak performance of mining shares often dampens investor enthusiasm. Before watching this video, please subscribe to our channel, hit the bell icon, and share it with anyone who might benefit from it.
Going back to the first of the year, it had just gotten so crazy by the end of December about how there were going to be 7 rate cuts, and all this jazz. And the bond market had been rallying and the dollar was falling. And if you remember, gold tried to break out on the 1st of December, and then it got a manufactured rug pull on Sunday night, whatever that was, the 3rd, into Monday the 4th. And that kind of stalled the breakout for about 90 days. And then but we didn't know that, that the breakout was coming. And the first of the year, it was like, most everybody knew there weren't going to be 7 rate cuts. The Fed was telling you, they've been slow walking this stuff for a long time. It wouldn't be more than 2 or 3. So you knew that had to get worked out. As it got worked out, the dollar rallied, 5 or 6%. The yield on the 10-year note went up, 50, 60 basis points. And you'd have thought, oh, wow, man, they're going to beat the snot out of the precious metals in the first quarter. And the opposite happens. I know we've talked for the last couple of years. I know I've included it in my little annual thing I do in January. Then once you make a new all-time high and break out in anything, you generally add about 10% to price just from, good feelings, some good publicity. People think they're missing out, and so a whole bunch of new money rushes in. And that's why I always thought gold might go to 2,300. Well, and here we are, 25 something, and have maintained and have broken out since, even a little further of, then we go into this 3.5 month range. Now we've broken out of that. So it is really almost kind of counterintuitive what happened, what has taken place, and it leaves old time analysts such as myself, kind of wonder, okay, what did we get wrong? What am I missing here? And I'm not sure I have those answers at this point. But I'm not arguing with 25, $50 gold, 25.50. That feels pretty good. 1st of October last year, I'm on vacation. I'm in Vegas to see U2 at the Sphere, and I'm sitting by the pool, and I'm looking at that account, and it's $33,000. And at the time, Bitcoin was $30,000, and it actually crossed my mind. I'm down from 50 down to 33, and I'm like, screw it. I should just blow this out and buy one, Bitcoin with it. And I don't. Gold then, hey, and it's great. Gold goes from 1,800 to 2,500, and I finally blew that account out at $25,000. So gold's gone up by 30 some odd percent. And this basket of exploration companies has gone down, which again, it's not the company, not the manager's fault. It's just a really hard industry right now. And so anyway, tying this all back together, everybody there's so many people that are in the precious metals for the right reason, but they want to make some extra fiat with gold mining companies, and they're not. So many of them aren't doing anything or are down versus where they were a couple of years ago or 10 years ago or 20 years ago. That people just feel depressed. They've gotten gold up, but they haven't gotten the miners to go anywhere. And there's a really interesting correlation between silver and the GDX that people should explore sometime. I wonder, maybe that's a way that sentiment gets controlled. But I digress. So I think that's probably sentiment is that one, you're happy to see gold go up, but at the expense of, chaos and madness. And then your mining shares aren't going up. And it just seems like it's just depressing. So anyway, then to the COT report. I mean, remember I mentioned the gold breaking out and going 10% higher a few minutes ago. This may seem like an hour ago because I've been talking for so long in this answer. When gold broke out on the 1st of March, it was Friday the 1st of March, Fed Goon Waller had made some comments about future QE, and boom, it goes up $30, $40 intraday, and breaks out on the weekly chart, goes up $100 the next week. And then over the course of 5 weeks after that, it goes up another 250. So it goes from 2,100 to 2,450 in 6 weeks.
Craig Hemke notes that while gold is higher than in May, copper has dropped 20%, and silver has fallen 10% since mid-May. He explains that this trend reflects a lack of broad commodity inflation, which usually signals solid global economic growth and industrial demand. Recent market data supports Hemke's observations, showing copper's decline to its lowest level in over 3 months due to weakened demand expectations amid China's economic slowdown. Market analyst Adam Koos confirms that reduced demand from China, the world's largest copper consumer, is a primary concern influencing copper prices. Craig Hemke notes the silver market's small size and limited investor interest, emphasizing that it remains primarily overlooked despite some niche attention. Grant Williams' remark that nobody cares about silver underscores this issue. Despite this, silver has surged by nearly 25% in 2024, outpacing gold and establishing itself as one of the year's top-performing significant commodities. However, in relative terms, silver remains inexpensive. It currently takes about 80 ounces of silver to purchase 1 ounce of gold, compared to the 20-year average of 68 ounces. This disparity highlights silver's undervaluation, despite its recent strong performance. Let's get back to the interview.
We had that great run up in 2016, see the big, huge increase. Yeah. And then what happens? Price falls in the back half of 2016 and all those shorts get covered and kind of how we're all. So anyway, that's kind of the problem now. Now, silver took off. Now, silver's not quite the same as gold from a positioning standpoint. Silver took off back on March 31st. It was actually Easter Sunday night when it finally really got rolling. And if you go back and look at how the funds and the banks were positioned back at very first week of April, last week of March, it's not dissimilar from where they are today. It's pretty close. Banks might be a little heavier short, but the funds are about the same net. So there's room for hedge fund and speculator buying to come push silver back up toward the top, where it was back in May. But it's got its own little headwind. You probably may have seen me or heard me mention before. I kind of think of silver. I'm looking around for something to pick up. Think of silver as like the hinge of a teeter-totter, and on this side you got gold and the other side you got copper. And if you can elevate the whole teeter-totter, get gold and copper going up, then silver's gonna go up at the same time. But if gold goes up and copper goes down, silver kind of just sits there in between. And that's what happened since May. I mean, gold's higher than it was in May, but copper's down 20% from where it was in the middle of May, and this silver's down 10. So we need part of this getting silver. Why is silver lagging gold and all that kind of stuff? We need that kind of commodity reflation, global economy, physical fundamental play to kick in again. And it just hasn't for the last couple months. And again, you've heard me say it a million times. I mean, it's the end of the debt-based, the Keynesian system, right? And it's a mathematical certainty. You get to the point where you just simply cannot service existing debt. You can't grow your way out of it anymore. And the law of compounding interest just eats you alive. And that's what makes gold. I mean, it just doesn't make it, it's not complicated. The hard part, like I said, is the silver market's so small and it's almost like non-existent to investors. It's the old Grant Williams thing about nobody cares. I mean, you care. I care. Most everybody listens, cares. We all own silver, but it's just not on people's radar. It's just not. I mean, there are some companies that need it for their technology, so I guess it's kind of on theirs. But even for, talk about its use in solar panels or whatever. But I can't tell you for sure how many ounces of silver are in a solar panel. But if, $1 higher per ounce at the margin maybe doesn't make that much of a difference to the solar panel maker. I don't know. It just doesn't seem like the supply, demand, the market structure, how prices discovered, all that kind of stuff. It just doesn't seem like there's enough people that really interested in it to move the needle.
Gold is set to continue its upward trend, bolstered by anticipated Federal Reserve policies and ongoing economic uncertainties. As a dependable safe haven asset, gold has recently enjoyed significant price gains. In contrast, silver, despite its crucial role in industry and renewable energy, grapples with challenges such as market manipulation and limited investor interest, causing its price to remain volatile and closely linked to broader economic conditions. What are your thoughts on how recent economic developments will soon affect gold and silver prices? We invite you to share your insights in the comments below. If you found this video informative, please like, subscribe, and click the bell icon for more updates. Thank you for watching.